Well, welcome. We're going to be talking tonight about cash and controlling cash. Cash is very important to control in any business. It's the most liquid of all assets. In fact, when you talk about liquidity, you talk about how readily convertible that asset is turned into cash. So, for instance, cash is the most liquid. Then you have accounts receivable, which is next in line, because when you collect on those receivables, it turns into cash. Inventory is next on the line. So you have cash, receivables, inventories. So when you measure liquidity, you're talking about how readily convertible that asset is into cash. So cash, being the most liquid of all assets, we have to have tight controls over that cash. Internal controls are so important. So we need to make sure that the cash is controlled, because it can fly out the door, as we talked about. The only thing that flies out faster than cash out of the business are employees at 4:59 on a Friday. Anyway, so we're talking about cash, controlling cash. We're going to look at some problems we're going to do in a bit, how to reconcile the bank accounts and all that good stuff. So let me just share my screen with you for a bit, and let's talk about cash and control. So here we have spreadsheet up on the computer. You see that cash, again, is the most liquid of all assets. You need strong internal controls over cash. How do you have strong internal controls? One is having separation of duties. It's important that you have, where possible, have people performing, for instance, cash over cash. You have different people performing operations. For instance, you don't want the same person who is issuing the invoices to the customer being the same person who is depositing the checks into the bank, and the same person who is applying the cash receipts against that customer in the system. Because what could possibly go wrong with that? There could be several things wrong with that. If you have dishonest employees, they could perform fraudulent acts because they have their hands in too much of the processing of the cash. They can make a fictitious invoice or what have you. Post a cash receipt that never happened, and then pocket the cash. So anyway, it's nice. It's good, as where possible. It's best to have a separation of duties. I know in smaller companies, it's not as easy to do, but you have other compensating controls. You have other people approving the checks before they're signed, and you have a couple of people in the process, so you can have some checks and balances. That's where it comes down to. So separation of duties is very important. Another one is make sure you don't have cash laying around. You want same-day deposits. Deposit that money in the bank. Don't just leave it laying around. Using a bank reconciliation is so important, because you want to make sure what's going into the bank, charges to the bank, the ins and outs in the bank, the debits and the credits are all accounted for. So the ending balance is correct, and you don't have any errors in there or whatever charges you might have missed because you don't see them until they show up in the bank statement. Oh yeah, look at that. There it is. There's a charge right there, or a bounce check. We'll talk about that. So we'll talk about bank reconciliations in a bit. And you want to limit cash payments to small expenses. We'll talk about petty cash. All right. So those are items we'll be talking about. We're going to be focusing on bank reconciliations and petty cash entries. So let's get right into it. So let's call up the spreadsheet here. Oops, let's go petty cash. I created this problem for us to go through, a petty cash problem. So why use petty cash? Well, petty cash, you might have seen petty cash in your company where you're at. Typically, you have one custodian who is responsible for the box. Typically, you have a box and you have small denominations in there, 5s, 10s, 20s, dollar bills, and some coin. And what is it used for? It's used for small office type expenses, whether it's postage stamps, a pizza for the office, whatever, maybe some small office supplies, mileage reimbursement for running an errand or something. It's the small expenses. Again, you don't see large corporations transacting in cash. Could you imagine GE buying a turbine for for millions of dollars and take out a wad of cash and there you go, here's the money for the turbine. No, it doesn't happen that way, right? They cut checks or issue ACHs or wire transfers or what have you, so they can account for it in the bank. It flows through the bank. They can reconcile all the payments, all the receipts, cash receipts, and all the cash payments in the bank. So petty cash is only used for those small items. And having a petty cash box is no different than if you're a cashier or a teller at a bank. You have responsibility for that drawer. Well, a petty cash custodian has responsibility for the box. And how does it happen? Well, in this example, let's take a look at it. As the following petty cash transactions were made by the ABC Corporation during the month of July. So we're going to record the transactions below in the general journal. So on July 1st, they established a petty cash fund. So they never had one. They said, let's have a petty cash fund. We need it for small cash expenditures during the month or what have you, as they go. So they cut a check for $1,100, go to the bank and cash the check and bring all the small denominations and put it in the box. Typically, this box is like a metal box, typically with a lock on it. And you have a drawer on top, and underneath you put your receipts, what have you. Okay, so the money's put into the box, the petty cash box. So you have one person in charge of this box. Why one person? Because if there's any money missing, you know who's responsible for it. Okay? If everybody's responsible for it, nobody's responsible for it. So we have to make one person responsible for the box. Okay, again, no different than a cashier responsible for their drawer or a bank teller. So anyway, someone comes to the cash custodian during the month. They have some delivery charges. They hand in the receipt. The petty cash custodian gives them some money, says $25 at one time, $50 another time, what have you, amounted to $125 during the month. And the petty cash custodian will have a log of all these cash payments, who they paid it out to, how much it was for, and all that. So there is control over that. And then miscellaneous repairs to office equipment, they had to pay somebody to come in and fix the copier. You know, those copiers are jamming all the time, so you have to have someone to fix it, right? And office supplies, they bought some small supplies for the office, pens, pads of paper, paper clips. I can never get enough paper clips. You know, some strange thing about paper clips, whenever I reach for one paper clip, I get about 20. They're like the barrel of monkeys. You ever play the barrel of monkeys game? You reach in for a paper clip and they're all tangled up. How did that happen? How does that happen? I don't even know. Anyway, so office supplies. Then donuts and coffee for the office staff. Let's face it, everyone needs some coffee every now and then to wake them up, right? Get them going for the day. So these are all the expenses that occurred during the month. And you see it totals up to $898 worth of expenses. I just hovered over these four cells and you can see the sum of $898. So the cash in the box before reimbursement was $182. Okay, so there's $182 before the reimbursement. They spent $898. So if I get my calculator, 898, whoops, 898 plus 182. That's should be 1080. That was 1080 accounted for, right? The $898 of expenses, plus the 182 that's remaining in the box. We've only accounted for $1,080. Well, we need to account for how much? $1,100. So there's $20 missing. $20 are short. How could that be? Well, maybe when they reimbursed somebody, the two 20s were stuck together. They gave them an extra 20, and the person didn't even know about it. No one knew about it. They just gave it to them. That could happen. Or maybe the petty cash custodian forgot to record something. They gave money, $20 for a pizza for someone in the office to go get one for someone's coming in, a customer or whatever, they want to get a pizza. And they gave $20 out and they never recorded it. That could happen too. Or it could have been stolen. Hopefully not. Okay. So the point is, you want to make sure at all times you're accounting for the $1,100, whether it's in the form of an expenditure that's recorded or cash remaining in the box. So now on July 31st, they go out and replenish the box. And then on July 31st, they realize that you know, the cash fund needs to be increased. We're going through this money too quickly. Let's bump up the petty cash account. So let's walk through these transactions. So the first one, on July 1st, we established a petty cash fund for $1,100. So we'll find an account. We're going to call it petty cash. Debit petty cash for $1,100, and we will credit the account called cash for $1,100. Okay, so it's coming out of one cash account and going into another. Okay, so this, once you establish this petty cash fund, it stays on the books at $1,100 in this case, or until you decide to either increase it or decrease it. It does not get impacted when you reimburse it, as we see in the next transaction. Okay, so on July 31st, we need to reimburse the petty cash fund for the $898 of expenditures here, plus the $20 that was short. So we're going to make an entry for all these expenses, and we're going to credit cash for the check we need to cut to reimburse the petty cash box. Okay, so we need to cut a check for $918 because there's only $182 remaining in the box. We have to bring it back up to the $1,100. So we're going to debit all these expenses here. So we have delivery expense. And that was for $125. Then we have miscellaneous repairs expense. For $230. Then we have office supplies expense. That's for what, $468. Then we have some meals expense. And that's for 75. Whoops. Come on. 75. Sorry about that. And then we have the cash, the check that we're cutting is for $918, right? The difference between the $1,100 that we established in the petty cash fund minus the $182 that's still in the box. We have to cut a check for $918. But the problem is our expenses only add up to $898. We have a $20 shortfall here. It's going to be debited to this cash over and short account. Okay. So we're going to monitor that account. If that account gets out of hand, we may have to either look into it first of all, and we're going to have to talk to the petty cash custodian. Perhaps they're not the right person. Perhaps we need to fire them. Hopefully not, but maybe move it to somebody else who's more detail oriented, that will not have overs and unders. So that's something important. I know when my wife used to work as a bank teller, they would watch that over and under so carefully. So anyway, it's very important. So then there it is. So you establish a petty cash fund, and then when you reimburse it, you cut a check to reimburse it. You go take this $918 check, go to the bank, cash it, get all these small denominations, put the money back into the box to add to the $182 that's still in there. So now you're back up to $1,100. Now the new expenses start rolling in. Okay, and that's how you do petty cash. Okay, so it's on July 31st, though, we realized, let's bump up this petty cash box. I don't want to have to reimburse it as much as we are. So let's bump it up a little bit. So when you bump it up, we're going to put more money into the petty cash box. So we're going to adjust the petty cash account up by $150, and we're going to cut a check and go to the bank and get some small denominations again and put it into the box. So now we have to count, the petty cash custodian now has to count for $1,250, not just $1,100. Now we have $1,250 to account for in the box. Okay, so that's petty cash, and it's used for small cash expenditures. And again, you need control over it by having one person operate the box. Okay, that's it for petty cash. Now let's talk about a bank reconciliation, because that is next. Bank reconciliation. So let's look at that. I got another document here I'm going to put up on the screen. Hopefully you can see them both. All right. shrink this one down a little bit. Whoops, not that one. Okay. Okay. So here we have a bank reconciliation. And how often should you perform a bank reconciliation? Every month. I remember one of my first jobs out of college, I had to work at this small company in Boston. They had not done a bank reconciliation for over a year. It was painful. I had to go through many months of reconciling. The good news is I got real good at reconciling bank accounts. The bad news is it was a lot of work. So we're going to walk through a bank reconciliation here. I've made again a spreadsheet. So what we're looking at is a bank reconciliation of this furniture company. And we're going to look at what's involved with a bank reconciliation. Okay, it's important we do it so that we confirm that the balance per the bank equals the balance per the book. So we're going to do a reconciliation per the bank, and then we're going to do a reconciliation per the books, and hopefully the adjusted bank balance will equal the adjusted book balance. All right. And when it does, you do the happy dance. It's always a great day. And then we're going to journalize anything that's on the book side of the reconciliation. We're going to journalize, and I like to break it out into two entries: those that add to cash and those that reduce cash from this bank reconciliation. Okay. So let's get into it. You'll see a Word document up here on the right. So we have the Bueller Furniture deposits all cash receipts each Wednesday and Friday in a night depository. I love that name, depository, after banking hours. Okay, so they deposit Wednesday and Friday night, the night depository after banking hours. So because it's at night after banking hours, it's going to show up the next day on the bank statement. So the company records the cash on Wednesday and Friday. However, the bank doesn't see it until Thursday and the following day, whatever that is, Saturday or Monday. Okay. So let's look at the data. So this is the bank reconciliation as of June 30th. The balance in the cash account is $9,317.40. This is per the books. Cash receipts for the month of June were $9,223.76. And then this is the detail of all the cash receipts. The $9,223.76 was comprised of these deposits that were made on June 1st, June 3rd, 8th, 10th, 15th, 17th, the 22nd, 24th, and 30th. And then during the month, they wrote all these checks for $8,395.66, check number 740, all the way down to check number 760. So $8,395.66. Okay. So what we need to do is, first of all, is we're going to see of this information that was either received by the company and deposited into the bank, or checks written by the company and should clear the bank. We're going to see what has actually hit the bank, okay, in terms of cash receipts and checks written. However, before we do that, we know we do a bank reconciliation every month, and we always have outstanding items in the bank. It's typically for timing adjustments. And the biggest timing adjustments in the bank are going to be deposits that are in transit overnight. Again, we're depositing them overnight. So let's say June 30th was on a Thursday. We deposit overnight on June 30th. And we record that on our books on June 30th. However, it doesn't hit the bank until the next day, which is July 1st. So it's not going to show up on the June 30th bank statement, even though we record it. So it's a reconciling item. It's going to show up on the July statement. So when we're trying to reconcile apples to apples, you're not going to find that June 30th deposit on the June 30th bank statement. It's going to show up on the July bank statement. And then you have outstanding checks. You cut some checks at the end of June. By the time you mail them, put them in the mail, and they go out to the customer, your vendor that you're paying, your supplier, by the time they get them, deposit them in the bank, it may be a few days to float, right? So end of month June checks might be outstanding until July. Okay, so then they're going to show up as outstanding checks at the bank, on the bank side. They haven't cleared the bank yet. Okay, But before we look at current June, we have to go back and look at May. So we have to look at May's reconciliation. We see last month, we had the cash balance. And this is what a reconciliation looks like on the bank side, a book side. We have a cash balance for the bank statement. Actually, this is the bank, yep. Then we have the add deposit in transit. This is on the bank side, excuse me. So you have deposit in transit. There was $690.25 that was in transit on May 31st. Why? Because it hit the bank on June 1st. And then you have outstanding checks, number 731, 736, 738, and 739. These checks were outstanding at the end of May. So of all these items here, we have to check to see which of these items hit the bank in June. So we're going to go one by one, looking at the bank statement. So first, we're going to check off the May items to see if they cleared the bank. So let's take a look at the first one. Deposit on transit, May 31st. Let's go to the bank statement, and here it is, the bank statement, American National Bank of Chicago, from June 1st to June 30th. Here is the ending balance in the bank, the beginning balance, okay, and the ending balance. Okay. So we see that on the left side, we have the checks that cleared the bank, and on the right side, we have any deposits that cleared the bank. And you see right here, on June 1st, the $690.25 cleared the bank on June 1st. So we know we can check this off, that cleared the bank, so it's no longer a reconciling item. Okay, it cleared on May 31st, it cleared on June 1st, so that's good. Now we're gonna look at all these 4 checks to see if they cleared the bank. So we'll go to check 731. We see 731 cleared the bank, so we can check that off. And it cleared it for the right amount, 162.15, okay? And then we see check number 736 for 345.95. And that cleared the bank for the same amount. And then we see check number 738 for 251.40. And we see that had not cleared the bank. 731, 736, 739, 738 is a reconciling item. So let's go back over here and we can enter this in as an outstanding check. Check number, is it 738? And if it cleared the bank, it's going to reduce our cash, so we have to show it as a negative to our cash account, okay? So let's keep going. Oh, before we do, let's put the beginning, the cash balance going to the bank statement right here, which is the 13,624.71. Okay, that's what the bank statement is showing. Okay, and we have so far a 251.40 reconciliation. We should put a formula in here. Okay. So as you reconcile, it's going to adjust this adjusted bank balance. Okay. So we took care of, and then we have check number 739, that cleared the bank. So we took care of all the May items. All these May items here that were outstanding on at the bank have now cleared except for check number 738. So now we can move on and look at June. So we're going to start with the deposits, and one by one, it's a meticulous exercise, but it's accounting is fun, let's face it, right? So let's take a look. First, we have check number 108050, and that was deposited on June 1st. So we should see that clearing the bank on June 2nd. So let's take a look. And we see on June 2nd, we see the 108050 clearing the bank, yeah, the deposits. So that cleared the bank. That's good. So that's not a reconciling item. So let's take a look at the next one. Take a look at here, check number. Deposit on June 30th, 854.17. The 854.17 cleared the day after. Then we have check, sorry, not check number, deposit on June 8th for 840.50. And we take a look on June 8th for 840.50. All right, so far, so good. Okay. Now we look at the next one, June 10th. We had 996.61 as our deposit, and the deposit is, 896.61. Huh, something happened there. All right, we made an error. And if you look down the fine print on this problem we're doing, assume any error found was an error made by the company. Let's assume that, okay? And even in any exercise you might do, okay? Unless it says otherwise, let's assume the company made it, not the bank. Okay, banks don't make errors, do they? Well, I guess they do. All right. Actually, I found one last month in our bank, so let's keep going. So 896.61 is the actual deposit, and we recorded on our books as 996.61. So we overstated our cash. So we have to adjust our balance. So this, down here, this is the cash balance for the company record. So again, the top part is related to the bank. The bottom part is related to the book balance. Okay. Sometimes I like to see these side by side, but we're going with this format for now. But either one. You can put the bank on one side and the books on the other, or just do it, stack them like this spreadsheet is. So we have error in the June 10th deposit. That was for $100. We overstated it, so we have to reduce our cash by $100. Okay, error in the June 10th deposit. It cleared the bank, but it just cleared. We made an error, so we have to adjust for that. June 15th, 882.95. We see here on June 16th, 882.95. That cleared the bank. Beautiful thing. Okay. Then we have June 17th for 1606.74. So we have right there the 1606.74 that hit the bank. And June 22nd, 897.34. Should see that on the 23rd for 897.34. Then we have the June 24th for 947.21. And you see that hitting the bank on the next day, June 25th. And you see there's no other deposit after that. So this deposit, which was deposited on June 30th, we know it's always a day late. There's only 30 days in June. So this hit July 1st. So that's an outstanding deposit. So we're going to put here, up here, deposit on June 30th, not recorded by the bank. And that's going to be for the 1117.74. It's going to be positive, right? Because if it had hit the bank, this balance would have been higher by $1,117.74. But it hasn't hit the bank yet. So it's an adjustment. It's a timing difference. It's going to hit in the July statement, but it's a reconciling item for now because we've recorded on our books, the bank hasn't seen it yet. Okay. So now we took care of all the deposits, except there's one thing that I looked at here. June 24th, it cleared the bank. However, it's 947.21, but it cleared the bank as 942.71. So we made a little transposition error there. We transposed some numbers. So we're actually, again, we overstated our cash receipt by $4.50. So again, we have an error. This time in our June 24th deposit, we overstated by $4.50. Okay. So we've accounted for all our deposits so far. We have some other items on the bank statement we'll talk about in a bit that we passed over them here, but MS miscellaneous, some miscellaneous deposits came in, and we see some other codes here, NSF and SC. We'll talk about that in a bit. Okay, but let's get through the other reconciling items here. Let's take a look at all the checks. Okay, let's see the checks that clear. We wrote all these checks. We know that the check 738 from May is still outstanding. So now we look at all the June checks to see if the June checks cleared the bank. Okay, so let's go one by one. We have check number 740, 237.50. So we have check number 740 for 237.50. Check. Okay, 741, 495.15. That one cleared the bank. Okay, so that's good. Right here, you can see it, 740, 495.15. 742 for 501.90. That cleared the bank. 743 for 761.30. 743 for transposition error again, 671.30. We recorded as 761.30. So that's $90 too much flying out the door. So we have an error. We have to account for error in check number. Was that 743? And we have to add $90 back to our book balance. Okay. Oh, we didn't calculate the book balance yet. Let's do that. We'll do it after we go through the rest of the checks. Let's keep going through the checks. And then we'll come back and calculate this cash balance according to the books. Okay. So now let's keep going. So we're on to check number 744 for 506.88. That cleared the bank. 745 for 117.25. That cleared the bank. 746 for 298.66. That cleared the bank. 747 is void. Okay, so that's not going to clear the bank. It's a voided check. That happens sometimes. Okay. 748 for 450.90. That cleared the bank. 749 cleared the bank for 640.13. 750 for 276.77. 751 for 299.37. 752 for 537.01. 753 for 380.95. 754 for 449.75. That cleared the bank. 755 cleared the bank for the right amount. 756 did not clear the bank. Okay, 750. There's a gap between 755 and 757. Typically on a bank statement, the banks will put an asterisk next to the check number if there's a break in the sequence. That just draws your attention. It gives the user of the statement some visibility to, okay, something's going on here. There's a break in the check sequence. Perhaps the check hasn't cleared the bank yet. Okay, and sure enough, it hasn't. So we have a outstanding check, and that outstanding checks go on the bank side. It hasn't cleared the bank yet. The books have seen it, but the bank has not seen this check number 756 yet. It's on the books right here, 756 for $113.95, but it hasn't cleared the bank yet. When it does clear the bank, it's going to reduce our bank account by $113.95. So it's outstanding checks are on the bank side of the equation of the reconciliation. Okay. So now we look at 757. That cleared the bank. But you see the gap between 757 and 760. There's some checks that have not cleared. And we see there's two checks here, 758 and 759 have not cleared the bank. So we could take those, copy them down, and just change the numbers, 758 and 759, and put the amounts. And those are 259.60 and 901.50. Okay. And they haven't cleared the bank yet. And let's see, the last one for 486.39 clears for 46.39. So as far as the bank goes, we are done with the bank side of the reconciliation. The adjusted bank balance is showing as 13,216. So what do you think the book balance better be? It better be 13,216 when we get done with the reconciliation. But before we go any further, let's look at the cash balance per the company records. It doesn't show here, but we can calculate it because we know the balance as of June. So let's put that in here. So we have the 9,317.40, okay, plus the cash receipts we recorded 9,223.76, minus the checks we wrote of 8,395.66. So our bank balance per the general ledger, per the books, before any adjustments, is 10,145.50. So you can see that initially we had over almost a $3,500 difference between what the bank was showing and what our books were showing. Okay, but we're not done with the reconciliation yet. We took care of any errors we made, but now we want to look at what is on the bank statement that we haven't recorded yet on the books. That's the next part of the bank reconciliation. We're going to go through the bank statement to see what may be on the bank statement that we have not journalized yet or put on our books yet. And we find these miscellaneous transactions. This was a note collected by the bank for $3,500. So we're going to put that on here. We have to journalize that. Note collected by the bank. That's going to increase our cash because the bank collected it, but we haven't recorded it yet. So it's in our bank statement, but it's not on our books yet. So we're going to make an entry to record that $3,500. Then the interest associated with that was $210. How do I know that? Because I know the problem. Okay. And any problem you might get in classwork or whatever, they'll tell you it's a note collected and interest as a result of it. Okay. So the interest associated with that note, typically notes have interest associated with it, and we'll look at interest in notes in another video. Okay, so interest on the note collected was $210. So that's going to be, again, we have to make an entry, journalize that to the books, $210. So we've accounted for all the deposits going in. So now we have these two other items on our books here. NSF. What in the world is an NSF? It's a non-sufficient funds or bounced check. One of our customers sent us a check. We deposited it somewhere here in one of these batches during the day, during one of these days, and it bounced. Okay. And it shows up on the bank statement. There's nothing worse than a bounce check. We'll talk more about bounce checks in the next video on accounts receivable. So the bounce check, an NSF check, that is going to be recorded on our books because now we have to put that money back into receivables, take it out of cash and put it back into receivables and go chase the customer for payment. So that's going to be a reduction in our cash for $550. Okay. And we thought we had it, but think again, we don't. The bank shows it bounced. Okay. And then we have SC, which is a service charge. Okay, service charge. And that service charge, the banks are good at charging you service charges. They're going to make money somehow, right? The poor banks. Anyway, service charge. And that service charge was $75. That's a reduction in our cash. So let's add them all up. Let's put a summation here and add up all these adjustments. And they add up to $3,070.50. We add that to our balance per the books. Now we have $13,216. $13,216. Woohoo! We're good. It's a beautiful day. That's a beautiful thing. All we have left to do now is to journalize anything that is on the book side. We don't have to journalize anything on the bank side. Timing will take care of that. It's going to hit the bank next month, hopefully. If it doesn't, then you may have to contact the supplier and say, hey, you haven't cashed your check. What happened? Okay. So let's journalize everything that's on the book side. So let's talk about the stuff that adds to cash. So we're going to debit cash for everything that is increasing cash, and those are the $90, the $3,500, and $210. Add them all up, it comes to $3,800. We're going to debit cash for $3,800. And what are we going to credit? Okay, well, we have a note collected by the bank, so we're going to credit notes receivable. We collected on a note. And we'll talk more about notes in another class, another video. And that was for $3,500. So the notes coming off the books because now we have the cash. Then we have interest. We have interest revenue of $210. So we have interest revenue, $210. And revenues are always credited, right? Adds to our equity. And then lastly, we have the error in check number 743. So when we cut this check, we cut it for the right amount. Well, when we recorded it, we debited accounts payable for $90 more than it should have, and we credited cash for $90 more than it should have. So we're debiting cash for $90 and it's $3,800. So we have to put the money back into accounts payable that we took out too much, $90. Okay. So there is the entry. for the additions to cash. Now we have the reductions in cash, the $100 error, the $450, and these two at the bottom here. They total $729.50. $729.50 cash leaving the building. So we'll put that in as the credit to cash. Okay, what the debit's going to be to? Well, let's take a look at the first one. We have errors. Errors in these deposits, and they add up to $104.50. That means we debited cash for too much and credited accounts receivable for too much. So we have to basically put that money back into receivables on our books. So we have to debit accounts receivable because we applied too much cash on our books and what the checks really were for. So we overstated our cash and overstated our reduction in receivables. So basically we're reducing our cash and putting the money back into receivables for the overstatement of that cash receipt. Okay. And then we have a bounced check. That money has to go back into accounts receivable. I'll just list it separately here so you can see it from different $550. Because again, the money's back in receivables. We have to get back on the phone and say, listen, how come we didn't, what happened to your check? Send me a real one this time. Okay. And then lastly, we have the service charge. That'd be a miscellaneous expense, a service charge expense. We're gonna put the service charge expense. And that was for $75. Okay, so there we have. So we're gonna make these entries for June because we want our June ending balance to be $13,216. Once we make these two entries, it's gonna adjust our balance from $10,145.50 to $13,216. Okay, so I hope you enjoyed this video. And again, controlling cash is so important because it's so liquid. You want to make sure that you have tight controls over it. I'll see you all next time. You don't want to miss the next video on accounts receivable. I'll see you next time. See ya.